Hello, everyone. This is Andrew, Stock Success Mentor, and this is solely educational, just trying to help you and suggest to you ideas to better your trading. I know how hard the journey is. I've been doing this since 1994. I want to talk about the stock market today, especially the NASDAQ. It seems to be under some severe pressure. Um, Basically, what we try to do is, as I say all the time, is combine fundamentals and technicals. You buy on fundamentals and technicals, i.e., breakouts, and you sell on technicals. And you can see here, this is a 50-period exponential moving average, which we're surpassing, which is a guardrail for me. Once we're below that, and look at this volume here, I look to scale out on my trading account. I have two kinds of accounts. One is a trading, which is more short term, that I'm looking to take 20% profits, 25% profits. At times, there could be times to extend them, depending on rules, which I can delineate in another video. And then there's longer term holdings. But right now, where we're at is we had a lot of enthusiasm and exuberance in the market. You can see that also with the margin debt was in that extreme. You can see how far we pulled away from the 50-period exponential moving average, like in this point or this point. No one knows how bad it can get or just that it could just turn around. This is the reality. But what we're seeing here, like we saw here, was a lot of volume, which is negative. And a lot of the leading ideas, or let's say the ARC, which is they're also taking out the 50-period exponential moving average. I mean, it depends on which arc you're looking at, but it's not healthy. And it's also done in a lot of volume. And there's a lot of outflows in liquidity of this ETFs, of this family of ETFs. You can also look, like everything is negatives and positives. Look at Zoom. Zoom is knocking on the door of the 200-day exponential moving average. 200-day exponential moving average is basically the line in the sand. If you're above it, world's beautiful. You're below it, watch out, because you never know how bad it can get. I mean, I was hoping that we were building a base here and I'd be buying here, which is the Jesse Livermore pattern. Like it's a shakeout pattern. And maybe we're going to just sit here and turn right back up. And that's the idea of having a plan. On earnings, the stock really got hit. You can see their earnings and you can see the volume again here, which is also very important, always to watch volume. Another, let's say, name of the COVID was Amazon. And you can look at it two ways here. You can say that Amazon has catched up. There's just been a choppy motion, but it's also knocking on the door of the 200-day moving average, which is not good. There's another one, Datadog is another example. It hasn't hit that 200-day moving average. Like, you can see it. And also with earnings, selling off. This is all the negatives. I'll give you some positives. I always want to, be positive. Boeing got decimated. I mean, just decimated with COVID. It had one base here, which was just, let's say, straight up from the bottom, which wasn't all that favorable. And now we're trying to build another base. We're above the 200-day moving average. Just even from a common sense standpoint, people want to travel. People want to get out of their homes. People want to go away. So, I mean, you can combine just logic, but also the fundamentals. The fundamentals still have, like I said, the airline stocks and even the casinos and the hotels are impaired. Ideally, what we're looking for is the strongest stocks and the strongest sectors when the market's healthy. So the market's really not that healthy at this point, which I just demonstrated by these, like the leading stocks. And there's a saying like when the generals are being cut down, then the army starts to fall. And that's where we're at. These are the leaders of this, let's say, very unique rally. And don't expect it to be in this year to have something similar. I mean, who knows what can be. You have to take it day by day and be flexible. Like right now, my bias is being very defensive, being very careful. I also see that in my longer term trading. It's not really trading, it's investing, where just update it. See, like Alibaba. Hopefully it'll open. It's at 50%. 50% exposure. And in a good here you can see it 50% invested. In a good market, everything's 100%. Well, we're not there. I mean, I have a list of my stocks that we're in, but the allocations are falling. I just do this once a week. It's just much easier, and this is for the long-term commitment, and that's how you can compound money over much longer periods of time. But as I said, combine two ideas. One is a shorter term that ideally, let's say my honeypot is when my 20-period exponential moving average is above the 50-period exponential moving average in the Qs. I'll show it right one more time. And it's these points right here. You have these massive moves that were unexpected. And then again. And you don't need many long periods like this to make a lot of money. And then once you start pulling away from the moving averages, you have to get wary. So I hope you like this. I hope you find this very educational. I look to share my experience, my good points and my bad points that I've learned over all the years. And the main thing is to play defense because I don't want to say it's easy to make money when the market's healthy, but it's very easy to lose money in the stock market. And that's why you need a plan. So hope this helps, and please subscribe to my site. Thank you.